Hey, good afternoon, everyone.
Good afternoon, Professor.
Hi, Cedric. How are you? Uh,
I'm good, you?
yeah, good, good, very good. How about the other people? I see five in total. Alexander Harrison connecting, and Alexander, did you raise your hand a while ago? I uh, I see also Daniela and Deely and Matthews. Okay. I hope everyone is having a wonderful afternoon. Um, and how many of I'm sure some of you are still in the building, in campus. One thing when I do this online, one thing I'm concerned is the connection, right? Somehow in the building you have to connect through Wi-Fi, and somehow the Wi-Fi connection isn't that good, and that's what I uh, something that I have sensed, all this time. Okay, so I hope you can, if you're uh, asking me something, and if you're in the building, in the Fitterman, if you're in Fitterman, and if you're trying to, if you're connecting through the Wi-Fi in the Fitterman, um, please make sure that you raise your microphone volume so that at least I know it may not be still ideal, but at least um, so that I can hear you and uh, address your questions better. Okay, so uh, looks like I have currently seven people here, and let me just check how many are in the Blackboard in the forum. Uh, okay, I see like, seven. So it's almost the same. All righty. So let's go back to, okay, I'll have to check that email later. All righty. So in our last class, we talked about the tips, right? Treasury, inflation protected securities, tips. And the whole point, it's not a difficult concept. The whole point of, tips is to adjust uh, adjust the par value, right, by inflation. And inflation is measured by CPI. So if you make that adjustment, the par value is adjusted. So the coupon payment is also adjusted as well. Uh, and you have to remember that the reason they have tips is because Treasury is um, paying such a low return. Treasury is paying such a low return, and you all understand that you might wonder why is Treasury paying? Because Treasury doesn't have to pay high return, right? This is the concept that was covered in the first topic, right? Uh, you don't have to if you have a great credit rating. Your cost of borrowing doesn't have to be high, right? That's why we were talking about, credit um, rating, uh, credit score, and how borrowing rates will vary from one individual to another based on the credit score, right? Now, then the next question would be, oh, so not only Treasury, but can there be something like that also in the, excuse me, also in corporate bond? Yes, there is something like that in the corporate bond as well, but not very widely used. Not very widely used because corporate bonds are already paying a relatively good um, return compared to Treasury. And at least corporate bonds um, of course, there are corporate bonds like AAA. AAA grade corporate bonds, and AAA bonds don't pay very high interest because they are not as safe as the Treasury, but they are quite safe, right? So mostly, but if you don't like, low return of AAA bonds, then you'll have to move on to AA or single A or triple B, right? They will more than uh, cover for inflation. They will more than cover for inflation. Okay, so next topic is muni bonds. So one muni bonds, as you have seen, right? Muni bonds pay the return that is something between the Treasury and corporate. But muni bonds also, muni bonds have $5,000 face value. So muni bonds are basically huge chunk. I mean, if you think about it, and I probably said this in the previous class as well. Let me make sure this session is being recorded. Yes, if it is not being recorded, it's time and effort, completely wasted. I mean, it's not wasted, but nothing to show for it, right? At least if I have the recording of this later, you can fall back on it. There's, but without the recording, there's nothing to fall back on. Where was I? So yeah, as I said, remember muni bonds have $5,000 face value. I already talked about it, so I'm just looking for somewhere here. Yeah. So the face value of the muni bond. Now think about it. That means if you have $5,000, of course, the selling price of the muni bonds won't be, as you remember, this is muni bond, right? And the price is, I told you, this is percentage, right? All the prices are quoted as percentage of the par value, right? So that means, the selling price is 97.57% of the face value of 5,000. So it must be selling for about 4,800 something, whatever it may be. But anyway, if you have $5,000, you can buy only one muni bond. Now, compare that with the Treasury or corporate bonds. If you have $5,000, you'll be able to buy about 5 bonds, right? If you buy a corporate bond, you'll be able to selling currently at about 91.735% of the face value, which is $917.35. So you can buy at least five of them, right, with $5,000. And then think about it. If you need, so either way, you have about $5,000 invested in either corporate bond or muni bond. But the downside of the muni bond is that if you need $2,000 in cash urgently, right, there's no way you can only cash out $2,000, right? If it is corporate bond, you can cash out only, you can sell 2 bonds and cash out about, $2,000, which would be slightly less than that because the selling price is currently, $917, right? But that means, you can still keep $3,000 in this corporate bond that continue to earn 7% interest rate, continue to earn 7% interest rate, right, on those $3,000. However, with muni bonds, that there's no such an option. There's no way you can selectively only leave $3,000 in the muni bond and only cash out only $2,000. There's no way. Excuse me a second. So whether you like it or not, you have to sell because you have only one bond. You have to sell just that entire the whole thing. Then you'll cash out the entire 4,800 whatever, and then you won't have any more. You won't have that coupon interest of 4.5% anymore. So that's the downside of the muni bond. But the upside of the muni bond is the tax exemption, right? The interest paid from the muni bonds, right, is tax exempt. So that's one good thing about the muni bond. And if you think about it from the investor's perspective, I've been telling you, individual investors, generally, muni bonds are not held by individual investors. It's not that they can't. It's not that the individual investors are not allowed, but as I said, for individual investors, liquidity is a critical issue. You should be able to easily turn it into cash flow. I mean, suppose you are a billionaire and you have about $500 million that you don't need. If you're a billionaire, your billion is already you don't use billion every day. Most of your $1 billion is in portfolio, right? But let's say and so as a billionaire, you don't have such a urgent, liquidity need. So then what do? Most of your money can be invested, it can be locked up in a long-term asset, right? So if you're a billionaire, you can lock up your $500 million in muni bonds, and enjoy its, tax exemption, benefit, tax shield from the muni bond. But since most of the individual investors are not like that, most of the muni bond holders are institutional investors. So something like insurance companies and pension funds, because these institutions need a long-term cash inflow from investment, and they need something that pays fixed income on a steady, constant base on a long term, in the long term, right? In the long run. So they use they invest in muni bonds, and they have funds to mobilize, a huge amount of funds to mobilize to and buy these muni bonds. So now we need to so suppose the muni bond pays 5% interest rate. Investors compare, if you're investing in muni bond, definitely this tax exemption is tax shield is uh, a big point. It's uh, it's a focus. So let's take a look at this example. Investor in 35% marginal income tax bracket. What this means uh, is that you all understand what marginal tax rate is. That's if you make one more dollar, what tax bracket do you fall into? We did it this in topic 2, um, uh, and if your marginal tax bracket is 35%, that means no matter what you make now, right? Any additional income you make uh, will fall into this 35% tax bracket. So this investor has $100,000 to invest either in corporate or in muni bonds. Okay, and the corporate bond pays 7% coupon rate, whereas muni bond pays 5% coupon rate. And then some people may think easily and quickly, because corporate bond is better because it pays 7%. It's 2% more than what muni bond pays. No, you can't. Once again, you are forgetting that muni bond is tax free, but interest on the corporate bond is taxable, and taxable at what rate? Is 35% marginal rate. Then after tax income, if you consider after tax income, corporate bond uh, uh, interest from the corporate bond is only 4,550 after tax, right? 1 minus tax rate times 7,000, which is less than 5,000, which is muni bond, and on muni bond you don't pay any taxes. So this is something you have to consider, right? Whether uh, you can, you'll have to compare the after-tax income from the corporate bond to compare it with muni. On the other hand, you can compare muni yield, in other words, return from muni bond to the equivalent taxable corporate bond. Okay, which is simple. I mean, look at the math. Math is basically, so I'll have to put it here. So what was the after-tax income? After-tax interest from corporate bond was basically, before tax. They usually say pre-tax, right? It's easier to say pre-tax. Pre-tax interest times 1 minus tax rate, right? But then think about it. If you are solving it for this, which is, now think about it. Pre-tax interest income is basically the income to the income from the taxable taxable corporate interest from taxable corporate bond. So, in other words, this is equivalent taxable income, right? Equivalent taxable income. That's what equivalent taxable yield. Now, income is, of course, interest income is, these are in dollars, these are dollar values, right? But when we say yield, it's percentage, right? But anyway, if you're solving it for now, it's just math, pre-tax. What would you do? You would basically after-tax income, interest income, divided by 1 minus tax rate. Okay, so it's just solving the same equation for in reverse, for different variable, and which is exactly this formula, which is nothing. I mean, in this case, instead of dollars, they just used yield, which is percentage, right? Now, Muni yield is after-tax interest, because Muni is already after, before or after, it doesn't matter. Muni is because there is no tax, so after-tax means Muni here. So this is something about the Muni, right? However, for an investor with lower income, who belongs to 28% marginal tax bracket. I mean, in our previous example, tax rate was 35, marginal tax rate was 35. But if it was 28%, then corporate bond provides more after-tax profit than Muni. Okay. Therefore, Muni bonds are popular among high-income investors, those with a substantial marginal tax rate. Okay. Now, so we are moving on to, we already understand a lot about the bond, so I'm not going to go over this. We know what coupon rate is. That's the interest rate, right, on the bond. We know interest that the bond pays. Face value, the same thing, right? Face value, par value, maturity value, right? They all mean the same thing. Also sometimes called redemption value. Redemption. I better not write it there. Or redemption, because you are redeeming. I mean, it's the company, right? The company that sold the bond. Bond is debt, so they redeem their debt by paying the face value, right? Of course, until then they pay interest, right? So let's think about the how we value, the valuation of the bond. And we know two types of bonds, coupon bond and zero coupon bond. Let's think about zero coupon bond first. Zero coupon bond is straightforward present value of single cash flow. Why? Think about it. Here's let's take a look at this. Bond with par value of 1,000, maturing in 20 years, and price to yield 6%. That means, I've been telling you, price to yield 6% or selling to yield 6%, they mean the same thing. That means that's the way, that means, this is the discount rate, right? They never say in the problems, they never say use this as the discount rate. No. But the way it is worded is that the bond is priced to yield 6%, or the bond is selling to yield 6%, or the bond pays 6%, or similar bonds or comparable bonds pay 6%. What does that? And also, the prevailing market rate is 6%. These prevailing market rate. These are all the way it is worded, right? To say, this is the discount rate. Why is it worded that way? Well, first of all, price to yield. That means, I'm going to get to that later. When they say comparable bonds or similar bonds are paying 6%, that means the bonds of the same risk class. I mean, if it is, a single A, if the risk bond rating is single A, and on average, single A bonds pay 6%, right? Return. That's what is, that's what it means. So, and why is it then used as the discount rate for this particular bond? Because it's an opportunity cost, right? You can earn. It's the opportunity cost of the return you can earn if you don't buy these bonds. If you don't buy these bonds, then you would your choice is to invest in one of the other bonds of the same risk class, because you're buying this bond. You're thinking of this bond because you're particularly concerned about the risk. You want to buy. I mean, you want to buy if you're really if your priority concern is safety, then you will buy only AAA bond. But then AAA bond doesn't pay interesting return, right? Interesting return. They pay very low return. So you also want some return. And what do? You have to make a compromise. You cannot buy AAA because of low return, but you want to stay still safe. So you don't want to go below triple B, but triple B is good. I mean, it's still investment grade, but it's low, the lowest in the investment grade. So it is riskier than single A, right? Although it may pay a little more return. So that's why you are considering single A. And then if all the other single A bonds pay 6% on average, if you don't buy this particular bond, it will be another single A bond, and another single A bond would pay 6%. So in other words, if you buy this particular bond, then you are foregoing the return, average return from the bonds of the same class. Okay? That's why it is being used as the discount rate, because it's an opportunity cost. Okay? And then prevailing market rate. When they say prevailing market rate, that also means that's the prevailing rate for this risk level. Prevailing market rate, in general, it's very neutral. It means what you can earn from putting your money in the bank. But then that's too generic. That's too plain vanilla. You understand? That's too plain vanilla. Why? If you don't have particular investment instrument, then you can use plain vanilla bank interest rate as the prevailing market rate. But if you have a specific instrument, stock or bond, and especially if it is stock, because thanks to the well-diversified, well-classified, risk ratings, you can limit your risk exposure. So if you are only investing in single A bond, right, then the prevailing market rate means the average rate for that class, right, for that league, right, not just plain vanilla rate. So anyway, think about it. What does this mean? Interpretation of this. This means in 20 years, you will get $1,000, and the interest rate until then is 6%. That's what it means. Okay, then now you can easily think, oh, then that means oh yeah, future value is, because this is single cash flow model, 1 plus R raised to N, where N is 20, R is 6%, right? And future value is 1K. You will know, oh, then, this is solving for principal, or the present value, which is, FV over 1 plus R raised to N. So, which will be, 1K over 1.06 raised to 20. But then you take a look at this, and you see what is going on. Why is it 3%? Why is it 3%? And why is N 40? This is because you have to remember that the bond is on a semi-annual cycle. The bond is on a semi-annual cycle. In other words, R is not 6%. What 6% is, that's APR, that's annual rate. Okay? So, and M is 2. Always remember, for bond, M is 2. Compounding frequency is 2. So, then what is R? R is APR divided by M. So, that makes this 3%. And also, this is not N. This is T. 20 years is T, right? So then and M is 2. So N will be 40. That's why. M is 40, right? N is 40. You have to remember that. Bond is on a semi-annual cycle, okay? So although, and you might wonder, but this is not even coupon bond. This is, zero coupon bond. Even if it is zero coupon bond, right? All bonds are basically on a semi-annual cycle. Okay, so then solving it for present value, it comes to 306. Okay, 0.56. So this is zero coupon bond. So zero coupon bond is easy. Now also coupon bond is not difficult. So here's another. This is the example for coupon. A bond has 10 years to maturity. So years to maturity. This is T, terminal time, maturity. Yeah. A par value of 1,000, a coupon rate of 10%. What cash flows are expected from the bond? Here, just to make it simple, they assumed annual coupon. But again, annual coupon payment. That means, M is 1. Again, this is just for, simplicity, to make it simple. In reality, all bonds are basically, in reality, most bonds have, M of 2. So what cash flows are expected from this bond? Of course, every year, at the end of every year, it's $100, right? And at the end, at maturity, at time t, you get 1,000. So total at the end, 1,100. But anyway, all these hundreds, what are they called? Huh? I normally ask this question during the class, but then it takes so much time because students they forgot. Some may know, but they hardly say, and some have forgotten. This type of cash flow is called annuity, because isn't that right? This is annuity. You forgot annuity already? Annuity is a regular amount at regular interval. So it's $100 regular amount at regular interval for 10 years. So it's an annuity. Oh, so we know what we need to do. Valuation means what is it? What should it be priced today at time 0? Right? What's it today? What's it worth today? So it's basically present value concept. So the present value of so price of the bond, basically, price of the bond is basically a combination of present value of all these annuities plus the present value of this par value, or maturity value, face value or maturity value, right? A single cash flow, right? So we don't need to go through all of these. So we know the formula for the price of the bond. That means that's usually market price. But solving market price is what you see from the market transaction. Every day we see numerous transactions, and at the end of the day, there is a closing price of the day. That's the market price. Again, but if you solve it by math, if you solve it by the expected cash flow then it's called intrinsic value or fair value, intrinsic value or rational price. Rational price or fair value. And the notation for that, the symbol for that is B. Okay, that's the notation I use. This I use for market price. And market price, and that's the symbol I use for market price. But in case of bond, the market price and the intrinsic value may be different. Especially in case of stock, it's significantly different. It can be significantly different, and in case of bond, it won't be that much different. It could be, and under the condition of equilibrium, if the market that bond or that stock is in equilibrium, then the market price and the intrinsic value would be the same. But the equilibrium condition, equilibrium is a very transitory, it's a fleeting thing, right? Equilibrium is a short-lived, a fleeting, transitory thing. Equilibrium doesn't last for a long time. If ever they are in equilibrium, it's only very briefly. And it's always, disturbed. Equilibrium is constantly disturbed. Okay. So anyway, so this is what? This is, basically the expression for present value of all the present value of annuities, right? And this is, present value of that. So we know the formula for present value of annuities, and the formula for present value of this single cash flow. Okay, so this is why we had done the time value of money, because without the knowledge of time value of money, there's no way you can price bond or stock. I mean, we'll get to stock later, but basically it's all about present value. If you don't understand present value, you can't do it. You don't know why the formula is like this. There's no, okay, and it's important. It's more important to know why and how than what. Just memorizing something without understanding why is futile. It's just, it's a wild goose chase. Okay, it's just a wild goose chase. It's just, a useless thing. This is the quote from a astrophysicist, contemporary. I mean, there was, in the 1980s, there was Carl Sagan. Carl Sagan was, he's dead now. He's a great, cosmos, Still, you see those, his, series on the Science Channel, or, shows like Nova. And then, and the new another star in the recent years, since like early 2000 was, I forgot his name, Japanese American physicist, who is actually a professor at City College, Kiko, I forgot his name. And then recently, Neil deGrasse Tyson. This is a new guy who's gaining, Nat Geo, National Geographic is gaining very, popularity. But this is, something I like. This is in line with my own philosophy. Understanding what it is you're memorizing, even if you have failed to memorize it, is by far greater intellectual achievement than having memorized something and not knowing why. Okay? Understanding what it is you're memorizing. In other words, why and how. Right? Even if you have failed to memorize it. Right? That's more important. That's much more important than just memorizing it without knowing why. Right? So this is why we have done, time value of money. Okay. So with this in mind, we'll just take a look at the first example here. Consider a 20-year bond with 7 7% coupon. So we know that time, maturity, 20 years, coupon rate, 7%. Discount rate is 6% annually. Look, this is not the way it is worded. I've been telling you. How is it worded? The way it is worded is if the bond is price to yield, so if the bond is price to yield, %6, okay, or bond is selling to yield 6%, or similar bonds are paying 6%, right? Prevailing market rate is 6%. Anyway, a lot of, but this is 6% annually. That means, yeah, APR is 6%. But since M is 2, right? R is 3%. N is 40, right? You have to keep that in mind. And then if we do the math, coupon over, right? Coupon is the payment, right? All right. And then you'll come to $1,115.57, right? $1,115. So this looks, quite complicated, but think about it. This is another version of the same formula. This is what? Coupon. If you multiply it, it's going to be coupon over R, right? 0.003. I mean, 0.03, I'm sorry. It's basically, look, coupon over R, you multiply 1 over R, so 35 over R minus 35 over, right? You multiply, dividing by, if you divide, this is a fraction and you divide it by that, it's like, multiplying back, not multiplying back, but, A over B, right? Over C is A over B times C, right? Okay. So I think I don't even need this. Well, so and from this, okay, what kind of bond is this? I mean, is this a premium bond? Discount bond? Hmm? Anyone? Oh, we're already okay. So it looks like the time is up, but everyone knows this is a premium bond, right? And I think it's not a discount bond, but think about it. Why is it a premium bond? It's the answer is already here, right? Okay. Alrighty. So our time is up. So any questions so far? Any questions? Any questions? Are you guys there? Nobody's there?
Still here.
Okay. Only one person. Only one person. Okay. Alrighty. So that's it for today. And I will see you guys then, after the spring break. But even during the spring break, the main lecture is still released on schedule. So please catch up with everything, okay? So that you can be prepared for the quiz 2 shortly after the spring break.
Okay.
All right?
No
All
problem.
right. Take care, everyone. Have a great, good spring break. All right. All righty. So stop sharing.